Hello and welcome to today's webinar. Today's webinar is hosted by the GICP in conjunction with Covenant Review, and we're going to be looking at European high yield bond and leveraged loan covenant fundamentals, so a bit of a mouthful. My name is John Wilton, I'm a director here at the GICP, and we're joined by my colleague Shoshana Harrow. Shoshana, if you could introduce yourself.
Yes, thanks, John. My name's Shoshana. As John mentioned, I'm a senior director at Covenant Review, specialize in high yield bonds and dip my toe into leveraged loans as well.
Excellent, thank you. So just before we kick off, a very quick overview of the format for today's webinar. We will start off with a teach-in, essentially hosted by Shoshana. We are going to have some time for questions at the end as well though, so we'll have the chat functionality open through the webinar. If anything comes up, please do start to put your questions in, and we've set time aside at the end to focus on those. So with that said, Shoshana, over to you.
Great, thanks very much. Now, I'm guessing that some, hopefully many of you, are Covenant Review subscribers already and very familiar with what we do, but just in case, I'll give you a little bit of background about who we are. And that is a team of about 25 leveraged finance lawyers based in London and New York. And before we came to Covenant Review, we all spent several years, and as John and I were just discussing, many sleepless nights working for large law firms where we drafted bond and loan documents. So covenants are really our bread and butter, and we now put that expertise to work reviewing the terms of high yield bonds and leveraged loans in the US and the European primary and secondary markets. We publish event-driven special reports. We publish data-driven trendline reports and a host of educational materials. So if you'd like to learn more about any of the topics that we cover in this webinar, there is plenty for you on our website. And with that background covered, I'll get started with the introduction to covenants that you're all here for today, beginning with the really basic matter of what bond and loan covenants actually are. And that is they're legally binding provisions in the contract that governs a particular debt instrument. So on the bond side, that agreement is normally an indenture, sometimes a trust deed. That document doesn't actually get finalized and executed until the bonds are actually issued. So as an investor, you're more likely to encounter a detailed summary of the covenants in a bond offering memorandum. On the loan side, you find covenants in a facilities agreement. It used to be the case that as an investor, you would see a near final form of that document during the marketing period. But in the current market, the SFAs themselves are being finalized later and later in the marketing process, and you may only see a summary, sometimes not even a particularly detailed summary of covenants in a term sheet that gets circulated to lenders. Now, covenants as a contractual provision will regulate what the company and certain other entities in the wider corporate group can do or can't do or must do while the debt is outstanding. And the goal in drafting covenants is really to have a reasonable balance between, on the one side, the company's operational needs and its shareholders' interest, and then on the other side, creditors' interest. However, over the last decade or more, that balance has really shifted, and covenants today often skew much more towards borrower and sponsor friendly than they do towards creditor protective. So that makes it even more important to understand the covenant package in debt that you're investing in, because it's really central to understanding your risk as a creditor. Covenants effectively set boundaries for all of the things that you see here on this slide: your credit support, the risk of dilution and priming, capacity for value leakage away from the credit group, what happens if there's a disposal, what level of ongoing information you receive, what happens if there's a distress scenario and the company wants to engage in one of these liability management transactions that we read so much about, and on and on. So it's really imperative to know how covenants work in general, and then to know what the covenants in any particular deal actually permit. Now, one thing that makes that a little bit easier in the European market is that you're likely to see the same style of covenants whether you're looking at an EU bond or an EU loan. That wasn't always true. It used to be the case that most EU leveraged loans followed the Loan Market Association's standard form of facilities agreement, which had covenants that were structured very differently than high yield bond covenants. But today, the vast majority of widely syndicated TLBs, term loan Bs, in the European market have covenants that are virtually indistinguishable from covenants in a high yield bond indenture. As for why that is, well, the high yield bond product was developed originally in the US, and there's now this long market history and a pretty substantial body of case law interpreting New York law governed bond indentures. And when bonds came to the European market, they tended to stick with that form and governing law. Today, most European high yield bonds will be drafted up on a New York law governed indenture, not all, but most. The covenants themselves are not always the same. In the EU versus the US, there are definitely significant differences between the two regions in terms of what the covenants permit, what's market standard, and so on. But US and EU high yield bonds have the same general style and governing law. And over time, what we saw, particularly for companies who had both bonds and loans in their capital structure, is that the same style of covenants started getting incorporated into the loans. And the norm today is for a senior facilities agreement to actually have a schedule at the back of the document that looks exactly like the covenant section of a European high yield bond indenture. You can actually hold them up to the light and you won't see any differences coming through. And the SFA will actually specify that even though the facilities agreement as a whole is governed by English law, that schedule is to be interpreted in accordance with New York law. So there's just been this wholesale incorporation of New York law high yield bond covenants into the European TLB market. Now, again, despite this crossover, there are certainly differences, meaningful differences between what's the norm for bond and loan covenants to say in Europe, but the takeaway here is that it's really more apples to apples, excuse me, than it is apples to oranges. The other thing I would say when you're comparing covenants across deals is to remember that they don't spring forth from a blank page. Even for a debut issuer or borrower, there's generally a starting point, whether that's an industry precedent, a sponsor precedent, or a law firm precedent, or some combination. Now that can be really useful for understanding how a particular deal compares to the market, but it's also a cautionary tale because a covenant that clears in today's deal becomes precedent for tomorrow's deal. And you may find yourself as an investor pushing back against a term that's clearly aggressive, but meeting resistance on the grounds that it has already cleared in another deal. As you may know, if you've ever tried to read a facilities agreement or a description of notes, covenants can be quite hard to follow. They are full of legalese, they're not standardized, they don't work in the way that you might reasonably expect them to, and there are multiple loopholes. That latter point is something that companies and sponsors in their counsel are quite open about exploiting. It's now completely common practice to have a team of lawyers and advisors poring over covenant packages looking for ways to work around them and accomplish things that investors aren't always happy about. But the more you understand about how they work, the more you can really evaluate the kind of risk and reward proposition for a particular deal. So let's get into some specifics now and talk about the key covenants that you'll likely see in a European bond or loan. First up is a debt covenant, which not surprisingly regulates future borrowings, with the goal of making sure really that the company doesn't take on more debt than it can service and or repay. That covenant will also regulate which entities can incur additional debt, which relates to your ability to be primed. Now, separately, there'll be a liens covenant that regulates how much of the permitted additional debt can be secured and on what assets. Debt that's secured alongside you on the same assets will dilute your collateral value, and debt that is secured on assets that don't secure you will prime you. So the liens covenant is really intended to limit both of those things. Next up, you'll find in most deals a restricted payments covenant. This one has a very broad scope. It deals with dividends, equity purchases, investments, and certain junior debt payments. So multiple forms of potential value leakage that could see cash or assets move away from your credit group. You'll also typically see an asset sales covenant, which will set out conditions for disposals and the permitted uses of proceeds. Most deals will also include a change of control covenant that gives lenders or holders the right to request repayment if certain transformative events occur. You'll see a reports covenant most of the time that sets out ongoing information requirements. That's particularly important if you're dealing with a company that doesn't have public financials. In a loan agreement, you will find transfer provisions that determine your rights as a lender to trade out of your investment or not, as the case may be. There's no real equivalent in a bond document because bonds are essentially freely transferable. And then there are lots of others, including some requirements for future guarantees, affiliate transactions covenants that set out arm's length requirements for related party transactions, mergers covenants that set out conditions for business combinations or the sale of substantially all assets, and a dividend blockers covenant in a lot of deals that's intended to make sure cash can flow upstream from subsidiaries to your borrower or issuer so that they can service your debt. One thing that's very important to understand is that the debt and liens and restricted payments and other so-called negative covenants, meaning the covenants that prohibit actions, is that they're incurrence covenants and not maintenance covenants. And what do I mean by that? An incurrence covenant gets tested only when the company wants to take an action. It's not tested on an ongoing basis. For example, some covenant provisions will allow the company to do something if it can meet a leverage ratio test. That doesn't mean that the company always has to be below that ratio or even that it has to test its leverage ratio on any regular basis. It just means that it would have to meet that test if it wants to use that provision. A maintenance covenant, by contrast, does require regular testing and ongoing compliance. It might specify that the company needs to meet a particular leverage ratio quarterly, and if it exceeds a specified level, well, that would be a breach. Now, that type of covenant is almost never found in a high-yield bond, and while you used to find them in leveraged loans, they're now increasingly rare in those instruments too. Most syndicated TLBs in today's market in Europe are what we call cov-lite, meaning that the term loan itself doesn't have a maintenance covenant. Now, what you will see if the facilities agreement includes term loans and a revolver is what's called a springing financial maintenance covenant, which kicks in or springs into life only when utilizations under the revolving facility exceed a certain threshold, and the norm there is 40% of commitments. There's some sample language here on the slide to give you an idea of what these covenants look like. And you'll see that this one requires the company to meet a pretty generous sounding 8.9 times net first lien leverage ratio test. That's not unusual. It's quite common for the test to be set with 3 or 4 turns of headroom. So it's a pretty loose covenant in most cases. On top of that, the language here specifies that the ratio requirement only applies if a certain test condition is met on a test date, meaning here that the revolver loans net of cash have to exceed 40% of commitments. Now, if you notice, the provision will specify right at the top that this covenant is for the benefit of the revolving lenders only. So if the company doesn't meet the test when it's required to, it's only a default under the revolver. It's not a default under the term loan. Of course, if the default isn't cured or waived and the revolver lenders accelerate that facility, that could then trigger a default under the term loan, but it's really an indirect protection rather than a direct benefit for the term loan lenders. Okay, so let's talk now about how the negative covenants are typically structured. In most cases, the covenant will start with a general prohibition, so sort of a thou shalt not commandment, which you can see in these excerpts here. The first one's from the debt covenant, which says the company and restricted subsidiaries cannot incur any debt. The second one is from the liens covenant, and it says the company and restricted subsidiaries can't have liens securing debt. So if you're an investor, you think so far so good. But the bad news is that this general prohibition at the beginning of the covenant is swiftly followed by a long list of exceptions. So it's really more like you can't incur debt except for all the ways you can incur debt that are listed on the next 5 pages in fine print. These exceptions tend to fall into 3 categories. You can have ratio-based carve-outs, which allow the company to take an action if it can meet a coverage or a leverage ratio test, or sometimes if the ratio wouldn't get any worse. You'll then have multiple capped baskets that permit incurrence up to a certain amount, which is usually, in today's deal, set at the greater of a fixed amount and a so-called grower amount based on a percentage of EBITDA, or very rarely now a percentage of total assets. Some of these cap baskets will be general purpose baskets, so you can use them for any number of things, while others will be limited to a specific purpose. And then last but not least, you'll have uncapped carve-outs, which are really just general exceptions for a defined category of incurrence. So we'll take a look now at an example of each type of exception. And first up here is a ratio-based carve-out. You'll see that it's tacked on immediately after that general prohibition on debt incurrence that I showed you before. And it allows the company and restricted subsidiaries to incur debt if the company can meet a 2 times coverage ratio pro forma, right? Now remember, this is an incurrence test. It's not a maintenance test. So the company would only have to meet that 2 times coverage ratio if it wanted to use this particular carve-out to incur debt. It doesn't have to maintain that ratio. It'd be perfectly fine for the company to be below 2 times at any point. All that would mean is that it couldn't use this particular provision. The next example on this page is a capped basket that allows debt up to the greater of 85 million euros and 40% of EBITDA. This is a general purpose example, so the company could use it to incur any debt for any purpose. There's no language limiting the carve out to a particular type of debt. Now, by contrast, the first example on this slide is a specific purpose cap basket. Here, the company can incur debt up to the greater of 167 million euros and 25% of EBITDA, but they can only use that basket for capitalized lease obligations or purchase money debt. Next up on this page, there's an example of an uncapped category-based carve-out, and this one allows an unlimited amount of non-recourse factoring and securitizations. So one thing to keep in mind when you're looking at a covenant package is that carve-outs are independent, separate permissions. So your total capacity is really the sum of all the carve-outs. And the other thing to know is that the company can use more than one carve-out at the same time, whether they're doing something for the same transaction or separate transactions. And unfortunately for investors, it's not required to tell you which ones it's using. So it makes it a little difficult to keep track of how much capacity there may be at any given time. On top of that, companies are usually allowed to reclassify an incurrence under a different provision after the fact. So let's say a company uses its general basket to incur debt, and it uses that basket because at the time it can't meet that 2 times coverage ratio test, so it can't use its ratio debt carve-out. But 6 months down the line, EBITDA has increased, and now its coverage ratio is above 2 times, taking all of its outstanding debt into account, including that debt it just incurred a few months ago. In that case, it would be allowed to shift that debt from the general basket into the ratio debt carve-out. And lo and behold, now its general debt basket has plenty of capacity for it to use for something else. Okay, last but definitely not least, I want to talk about the entities that have to comply with the covenants, which we call the restricted group. And on the slide here, we've got a sample corporate structure chart. You might see something like this in a bond offering memorandum or in a lender presentation for a loan. And in this pretend structure, we have a holdco that's issued some senior notes, and its direct subsidiary called the company, which has issued senior secured notes and is also a borrower under a senior facilities agreement. And below the company, you'll see there are several subsidiaries. So there are 3 debt instruments, 3 sets of covenants. We'll talk about now who has to comply with which set. Let's start here with the senior notes. The covenants for that instrument apply to holdco and holdco's restricted subsidiaries, meaning the company and some of the company's subsidiaries. Those are the ones that are labeled guarantor restricted subs and non-guarantor restricted subs. You'll also see an entity labeled unrestricted subsidiary. That one is not subject to the covenants. If we move on then to the senior facilities agreement and senior secured notes, the covenants for those 2 instruments apply to the company and its restricted subsidiaries. Who are the company's restricted subs? Well, they're the ones that sit within the red dotted line here. Again, it's the guarantor restricted subsidiaries and the non-guarantor restricted subsidiaries. You see, though, that unrestricted sub, the unrestricted subsidiary, falls outside the restricted group. In this example, you'll see that holdco up top also sits outside the restricted group for the senior facilities agreement and the senior secured notes. So it's not subject to the covenants of those instruments. So if we put this all together, holdco is subject to the senior notes covenants and nothing else. The company, the guarantor restricted subsidiaries, and the non-guarantor restricted subs are subject to all of the covenants, and the unrestricted subsidiary is subject to none of the covenants. I just want to emphasize a little bit more the distinction between restricted subsidiaries and unrestricted subsidiaries. So both of them are subsidiaries of the issuer or the borrower, but the difference comes down to whether or not they have to comply with the bond or loan covenants. So restricted subsidiaries are subject to the covenants, whether or not they guarantee the bond or loans. That's really important to understand. As you saw in these structure charts, you can have guarantor restricted subs and non-guarantor restricted subs. Those non-guarantors must comply with the covenants, even though they're not an obligor under the debt, meaning they're not on the hook for payment as a guarantor. By contrast, an unrestricted subsidiary is not subject to the covenants. Now, by definition, it's also not a guarantor. But don't confuse a non-guarantor restricted subsidiary with an unrestricted subsidiary. Neither of those entities will provide a guarantee, but the restricted subsidiary is nonetheless part of the restricted group and has to comply with the covenants. Now, originally, deals included a modest amount of capacity for investments in unrestricted subsidiaries, and that was to give the company a little bit of scope for minority interest investments, some new businesses, things they might have a legitimate commercial interest in keeping outside of the restricted group ring fence, at least initially. But over time, that modest amount has increased exponentially, and there's been a real shift so that today unrestricted subsidiaries are used primarily as a way to subvert or work around covenants, and in particular to structure liability management transactions in distress scenarios. So it's important to have a good grasp on what they are and how much capacity the company has to invest in those entities. So now that you have an idea, hopefully, of what covenants are and how they're structured and who has to comply with them, I want to just briefly go through the key covenants in a little bit more detail and explain what you're likely to see in each one. Of course, there is a great variety from deal to deal, but there are some common features that you can look out for and compare. So first up, we'll talk about the debt covenant. And as we've already discussed, this covenant usually includes a ratio-based carve-out that allows debt subject to a particular ratio test. Normally, it's a coverage test like the one that we saw before. Some companies, particularly telcos, will use a leverage test instead, and more aggressive deals will let the company choose between the two. So that's a little bit more permissive. Now, as for the other carve-outs, these really do vary by deal, of course, but in most bonds and loans, you'll see first up something called a credit facilities debt basket, and you would be forgiven for assuming that they can only use that to incur loans. But lo and behold, the term credit facilities is typically defined far more broadly than that to include not only loans, but bonds and pretty much all forms of debt. So you should really think of a credit facilities basket as a camouflage general debt basket. There is also normally an actual general debt basket where the company is explicitly permitted to incur any type of debt. Again, most of the time this is an aggregate basket that allows debt to a fixed amount or a percentage of EBITDA over the life of the loan or bond, but some aggressive deals will make that an annually refreshing basket. Next up, you will usually see an acquisition financing and acquired debt carve out, and the standard here is to allow that type of debt if the company can either meet the test set out in the ratio debt carve out or if the relevant ratio wouldn't get any worse. And the idea here is that the only way that can happen is if you're acquiring something that boosts EBITDA, all right? You'll usually see something called an equity credit or equity contribution debt basket that lets the company sort of earn debt capacity from equity proceeds or capital contributions. So it's kind of a quid pro quo. If shareholders put more into the company, then leverage is permitted to increase, normally on a one-for-one basis. But punchier deals will allow a company to incur debt up to 200% of equity proceeds. Next up, there's often a basket for local facilities. These were originally drafted to permit working capital facilities, overdrafts, operating facilities, so something a subsidiary might need, but they've come to be worded a little bit more broadly to permit bilateral facilities, which again means they can serve as sort of a camouflage general debt basket. You also normally have a basket for lease obligations and purchase money debt. You have a carve out for receivables and securitizations and factorings. And in some deals, not all, you'll have what's called a pick your poison debt basket. And this one allows the company to convert some, if not all, of its restricted payments capacity into debt capacity, which we think means they can choose between two things that are poisonous potentially from a bondholder's perspective or a lender's perspective. You can either have value leakage through restricted payments or you can have increased leverage. These are sneaky provisions because you don't see on the face of it necessarily how much debt they could permit, but it is often substantial and definitely something to look out for. I won't go through all of the baskets, the remaining baskets on this slide because they're fairly self-explanatory, but you'll have them in the materials for reference. Now, moving on to the liens covenant, that one works a little bit differently depending on whether the assets that are being pledged are part of the collateral package for the bond or loan or not. If they are part of the collateral, then the general rule is that no liens are permitted other than a reasonably short list of permitted collateral liens. Permitted collateral liens will almost certainly include ratio debt, normally subject to a net first lien leverage ratio test. There's also normally permission to secure that credit facilities debt basket on the collateral. And if you have a capital structure that includes a super senior revolving credit facility, there is usually express permission to secure at least a portion of that credit facility's basket on a super senior basis. And then you'll also find permission to secure some, or in aggressive deals, all of the other material debt baskets on a first lien basis. Now for non-collateral assets, so the assets that don't secure your bond or loan, it works a bit differently. There, the liens covenant will typically say that the company can secure debt on those assets if the lien is a permitted lien, or if it grants the same liens over the same assets to the loan or the bonds. Now, capacity for permitted liens is usually not quite as expansive. There's often a general liens basket that can be used to secure any permitted debt, and permission to secure a couple of debt carve-outs or categories, lease obligations being a pretty common one. But in general, it's a bit more limited. Aggressive deals, that's not the case, so don't take this as certain. Always check the details of each deal. Moving on now to restricted payments. I mentioned earlier that this covenant really covers a wide range of actions, and most of the carve-outs that I'm going to talk about now can be used for any of those actions. So dividends, equity purchases, investments, junior debt prepayments. There is a wide range of what we call a general purpose carve-outs. Some, however, are limited to specific types. So if we think then about the main source of that general purpose capacity, you will likely find a build-up basket in a restricted payments covenant, which accrues or builds up capacity over time. It's based on an operating metric. Normally, that's 50% of consolidated net income, but in some cases, it'll be based on EBITDA less a multiple of interest expense. It'll also build from equity proceeds, capital contributions, certain returns on investments, and often these days a so-called starter amount. Now, in most cases, the company has to meet a couple of conditions in order to be able to use the basket, but these have really eroded over time, particularly in sponsored deals. Some deals will include then a second build-up basket called an available amount basket. This is a loan concept that has migrated to some bonds as well. And the basket is usually based on retained cash and a bunch of other components, some of which overlap with the build-up basket, so you can actually build double capacity if the deal isn't drafted properly. And in the worst cases, this basket will build from permitted debt. So you can actually build value leakage capacity by increasing your leverage, something we do not like to see. You will commonly have a general restricted payments basket as well as a ratio carve-out that allows restricted payments if the company can meet a leverage ratio test. You may also see a basket for what's called excluded contributions. You'll recall that I said capital contributions and equity proceeds can build capacity under the build-up basket, but that basket has conditions for use. Well, this carve-out doesn't. So the company can designate certain injections and have certainty that it'll be able to take them out later. There is often a carve-out permitting dividends after equity offerings. Most loans now also include a carve-out that will allow spin-offs of unrestricted subs. So in other words, if the company has designated and transferred assets to an entity outside the restricted group, it is then free to spin that subsidiary off to its shareholders. So it can provide sort of backdoor dividend capacity. And then you may also see baskets for sponsor fees, parent expenses, a certain amount of payments on subordinated debt, and in some cases, restricted payments that are made with asset sale proceeds. And then last here on the list, you'll see several carve-outs that are limited to investments. So these are not general purpose, they're earmarked specifically for investments. And although it's not entirely obvious from the way they're named and described, in most deals, the first 5 investment baskets that are listed here on the slide, so that general investments basket through the leverage-based carve-out, can be used to make investments in unrestricted subsidiaries. Now, as I said before, unrestricted subs are essentially liability management transactions waiting to happen these days. And I would say the most glaring issue that we see at covenant review and covenants these days is excessive capacity to shift value to these entities. So when you combine those general purpose carve-outs like the build-up basket with all of these 5 carve-outs here, the total can get pretty significant pretty quickly, and it's really something to pay good attention to. As for asset sales, this one's structured a little bit differently than the other negative covenants. It basically says the company can't sell an asset unless it meets certain conditions for consideration and uses the proceeds either to reinvest in the business or to repay certain types of debt. If proceeds are then left over after a certain amount of time normally a year, but sometimes longer, then the company has to make a par offer to bondholders or lenders, but only if the remainder exceeds an agreed threshold. And there are sometimes so-called step-down provisions that can reduce that offer requirement even further, subject to a leverage ratio test. The one thing to know about the asset sales covenant is that it only applies to things that fit within the definition of an asset sale. And normally that definition has dozens of carve-outs. So the company can usually make all kinds of disposals without having to comply with any of the requirements that I just explained. Moving on now to the change of control covenant. This one's more of an affirmative covenant that requires the company to make an offer to holders if certain transformative events occur, like a change in majority ownership or a sale of substantially all assets. You may see other triggers or events that would be a change of control in some deals, such as a change in the intercompany ownership structure, but it really depends on the document. You won't be surprised by now to know that there are several exceptions, including a list of permitted holders who can get majority ownership without tripping the change of control, and exceptions for widely held companies where there's no single majority owner. But if, in fact, a change of control does occur, then under a bond, holders will have a put right at 101, whereas under a loan, they'd have a put right at par. And last but not least, I will just touch briefly on transfer provisions in loans. Here, the general rule is that after closing, the borrower has to consent to transfers. Typically, the company can't unreasonably delay or withhold that consent, and if they wait too long to reply, they're deemed to have consented, but that really varies deal by deal, particularly in sponsored deals. There are normally some exceptions to the consent requirement for transfers. So for a euro-denominated loan, you often see an exception for transfers to lenders on a so-called whitelist, and there are often exceptions for transfers to other existing lenders and transfers after certain events of default. But on the other hand, there are some additional limitations. You may find that transfers to distressed debt investors are blocked, transfers to competitors are normally blocked, in each case subject to some exceptions. Transfers to defaulting lenders are blocked, and in some deals you might have a block on transfers to net short lenders. There can also be restrictions on sub-participation. So the more aggressive deals make these very tightly controlled. There are often notice requirements for transfers, sometimes in advance. There may be minimum hold requirements. So all of these things can really affect your ability to move in and out of your investments. Definitely something to check really carefully when you're looking at a loan. Okay, just before we move on to questions, I wanted to point out that we have a much more detailed e-learning series. It's available if you'd like to learn more. It's split up into 11 modules, as you can see listed here. They're quite bite-sized, you can dip in and out, and if you're interested, please do get in touch.
Great. Shoshana, firstly, thank you for that. It was a really comprehensive view, I think, as a start for everything. I hope that everybody in the audience found that useful and interesting as well. So, as you said, we're moving on to the question side of things. So, just to kick things off, the first one is, what are the key points that you look to if you've got 10 minutes to review a term sheet?
Oh, well, first thing you'd look at, of course, would be a covenant review report, I would say. As I mentioned, we review primary deals. We'll put the key concerns right up front. We have tables with day one metrics, and I think that's really an important thing to look for. But if you really wanted to focus on one thing, I would say investments capacity is critical, capacity generally. So I would look quickly at the headline figures, how much debt, how much value leakage, particularly to unrestricted subsidiaries, to try and get some sense of your risk of being primed to diluted.
Great, thank you. Another one, do you have to identify the entities for unrestricted subs at the beginning of your process, or can it be done further down the line?
Very good question. You can have day one unrestricted subsidiaries, and if so, you would disclose them. If you want to add an unrestricted subsidiary later, that actually takes capacity under your restricted payments covenant. It's considered an investment that's effectively equal to the fair market value of the company's interest in that entity or its assets. So yes, you can do it after the fact, but it requires capacity to do so.
Okay, great. Another short one, what is considered a blocker?
A blocker, okay, so you read about these things probably if you read about liability management transactions. There have been some famous or infamous, I suppose, instances where companies have worked around the covenants to structure or restructure out of court their debt in unfavorable transactions. Probably the most notorious one was back in 2016 with J. Crew, where they moved valuable IP out of the business. What then happens is covenant provisions get drafted that are designed to block those particular types of liability management exercises. They're often, they give a lot of comfort. So I think probably the most common question we get at covenant review about a new deal is, does it have a J. Crew blocker, a CERTA blocker, a Chewy blocker? And we can say, well, yes, but that doesn't quite get you there, because they plug one hole, but if water's gushing around it, then they might not be super protective, but that's what a blocker is.
So is the case they're often so specific that they actually may not end up being that protective?
Exactly right. Exactly right, yeah.
One more, which I think you'll like this one.
Okay.
How can we access the course which you mentioned at the end of the presentation?
Okay, so it is, if you are a Covenant Review subscriber, it is available to you at any time. You can email research@covenantreview.com and we will send you a link. It is super easy, no registration required, and you go.
Right. Yeah. That one wasn't a plug.
Okay. Yeah.
What are signals of the covenant packages particularly favourable or unfavourable for an investor?
So I would say if you pick up one of our reports and you see that they have, day one incremental debt capacity that's 3 times opening LTM EBITDA and massive headroom under all of their ratio tests, and our list of key concerns says things like pick your poison, particularly at 200%, you should start to get concerned. The other one, we go into great detail in the course. We didn't talk too much about financial calculations. Our most aggressive deals, I think, really bake in a provision that allows them to manipulate covenant calculations to give themselves even more capacity than you see from those headline figures. Those are the ones to look out for. Amendment provisions, usually quite weak, particularly in a bond. So ones where you find that not only are things aggressive day one, but can quickly get worse with not a whole lot of consent from lenders and bondholders would be ones to worry about.
I've got another one here, which is, does it make a meaningful difference whether the term is written under English, Welsh law or New York law?
It can do, and so that's a really interesting one. Obviously, as I mentioned before, there's this large body of case law for New York law governed indentures. And so for some things, there's a bit more predictability and certainty, and people understand their litigation risk a little bit more on the outset. But if it gets into court, there's some 2 really interesting litigations ongoing right now for Selecta and for Hunkemuller, companies who have New York law governed indentures, English law governed intercreditor agreements, and both of them have done these quite aggressive liability management transactions that happen to involve a particular mechanic under the intercreditor called a distressed disposal. And what is being alleged is that violates an English law principle that requires the majority to act in the bona fide interest of the class as a whole. It prohibits minority oppression. New York law, no such thing, right? We've taken similar types of occurrences, and there's case law saying absolutely fine. So things like exit consents, generally not as possible under English law, totally possible under New York law. So depending on the particular transaction at play, it could have a very meaningful difference.
Excellent. Okay, thank you. It looks like we have answered all the questions that we're likely to get for the time being. So if any do come to mind afterwards, do feel free to send us an email at institute@gicp.org. I'll pass them on and hopefully we can get back to you at a later date. Otherwise, Shoshana, thank you so much for joining us today and for giving us such a comprehensive view of the fundamentals here. If you'd like to find out more about Covenant Review, what's the best place to go?
Research@covenantreview.com.
Excellent.
Yep.
Okay. And from our side, the GICP will be running our next information session about the Global Credit Certificate on the 7th of January. We'll be lucky enough there to be joined by one of our faculty who's going to run through a little bit of detail in terms of what we really look at in the course. So hopefully we'll see you there. You can sign up for our website. Otherwise, thank you again for joining us today, and we look forward to seeing you on the next one. Thanks.